There are typically three main ways that we value a company, and I want to go through them really quickly here. And I'll do follow-up videos on each one of these so that you can get a sense of how to actually build these things out for a specific company. So let's dive in. Like the first main way of valuing a company is a discounted cash flow. What does a discounted cash flow do? Well, it basically takes a set of multi-year projections, let's say typically 5 to 10 years, and discounts that back to today to come up with a value. I think where it's very applicable is for very fast growing companies. So a company that doesn't have revenue today, but has invested a lot in technology or whatever it might be, and revenue and financial profile is on the come. It can be very relevant because you can't do the other methods on a company with no revenues or no EBITDA or no net income. But the biggest downfall actually is, well, there's quite a few downfalls to a discounted cash flow. And to be honest, it's my least favorite way to value a company typically. And that's because there's so many assumptions that can be made in a discounted cash flow. And so you can basically make the discounted cash flow tell you the answer that you want to hear, that your company's worth 10 million or 50 million or 100 million. And there's little tweaks to those assumptions can make a big difference, like the discount rate. What rate do you discount that cash flow back to today at can vary dramatically. Or the terminal value. How do you come up with what the value is of the business at the end of the projection period? We'll get into more of that detail in the specific discounted cash flow video that I'll do at a later date. But um, these things really sway the usefulness of a discounted cash flow. And because garbage in, garbage out, you put 40 projections in, you're going to get 40 value out. And a lot of time, buyers or investors or whatever it might be don't really pay attention to a discounted cash flow or don't really believe it. It's also called a discounted DCF as well as a discounted cash flow. So you'll hear that term quite a lot. So that's my view on discounted cash flow. Definitely my least favorite, but definitely something that especially accountants or valuation experts use a lot in their valuation reports and that sort of stuff. But something that if you're selling your business or you're raising capital is very infrequently used by most folks. The next one is trading comparables. So this looks at the average trading multiples for public companies and applies those multiples to a private company. So what that be? Well, Apple trades at a certain multiple of its revenue. The value of the business Apple, the enterprise value, relative to its revenue is a multiple. And you apply that multiple to your business. Obviously, you have to pick like-minded companies. So if you're an industrial company, you pick industrial company comps. If you're a technology company or a software company, you pick software comps. But this is a good way of you know, giving you a value based on other public companies. I think the pros here are it's actually very easy to get good data. So you can get those multiples that those businesses trade at quite accurately from their public filings and in real time because as the share price moves up and down, the enterprise value of that business moves up and down as well. And that's my second kind of pro is that trading comps are real time. So you can get the value of Apple today, value of Google today, or whatever the comp might be that you're using. And so it's reflective of current market conditions. Whereas when we look at precedent transactions, sometimes they can be a bit dated and therefore not reflective of the current market. Um, I think the downfall of using public company comps or trading comparables is often that the companies that you're looking at, the public companies, are much larger than the company that you're trying to value. And so there's inherently usually a discount, right? Like not every technology business is going to be valued the same way, the same multiple as Apple or Google does, are because they're the best in their business and they're so huge that they get a kind of premium for their size. And then the other factor as well, often, especially with smaller companies, maybe a part of their business is comparable to you, but not all of their business is comparable. So, for example, Google has so many different business lines. if you just apply Google's multiple to your business because you have one similar business line to one of their many business lines, you're not really getting a like for like analysis because you're comparing a conglomerate with multiple business lines to usually a single business line business. So that's definitely a downfall for using public company comps. What are they also known as? And they're known as trading comps, public comps, or trading comparables. You'll hear those phrases quite a lot. And then the last one, and personally my favorite, if you can find relevant transactions, is looking at precedent transactions. And so what is this? This is basically looking at the average multiples that were paid in similar M&A transactions, and then applying that multiple to your company. So you might have had a competitor that was bought by private equity or bought by a strategic, and a multiple was disclosed so that you knew that it traded at 2 times revenue or 5 times revenue. You basically just take that 5 times revenue and apply it to your revenue, and you've got the enterprise value of your business. So we'll get it again. We'll get into more of this in a follow-up video, but it's a good way of looking at relevant transactions in your space and applying those multiples to your business. It's definitely the most applicable way to value a mid-market or a smaller private business than looking at public comps. So that's probably, it's one that in the M&A business we use the most to kind of approach valuation. The downside of it can be that it's very difficult to find relevant transactions. You might find relevant transactions, but there was no value disclosed. A lot of transactions in the private M&A world are not disclosed. A valuation is not disclosed, so you don't know what multiple it traded for, as a multiple of revenue or as multiple of EBITDA or a PE ratio. So that can be hard, finding actual relevant transactions that have disclosed numbers that can be useful. And then sometimes it can be dated. You might be able to find that relevant transaction or a few relevant transactions with multiples disclosed, which is great, but they might be 4 or 5 years old. And an example of that might be that, you know, you might pull a transaction from 2021 or 2022 and try to apply it to today in 2024, and it's a very different market today. And so they can sometimes be a bit of a disconnect between those precedent transactions, especially if they're a little bit dated. And it works both ways. They can be less than today's value, or they could be more than today's value. But they're very common to be used in this kind of value in a private company, and usually very, very good, or the best way that we find valuing a business. What are they also called? They're called M&A comps or M&A precedents, as well as precedent transactions. So anyway, these are the three main valuation methods. There are a whole ton of other valuation methodologies that people use, but I would say these are the most common methodologies that are used by investment bankers to value different types of businesses. Hopefully this has been helpful. I will definitely do follow-up videos on each one of those. If you have any questions or comments, leave them below, and I'll see you next time.